You're listening to the Retire Coast podcast, where money, business, and lifestyle come together. Join us each week as we explore smarter financial planning, starting and growing businesses, and building the life you want at every stage, from millennials and Gen X to today's retirees. And now, here's your host, serial entrepreneur, author, and financial guide, Bill Anderson.
Welcome back to Retire Coast. Our topic today is the 2026 Federal Income Tax Guide. We have 18 strategic tax-saving methods to explain to you. And just to be clear, we're talking about your 2026 taxes that are going to be due in 2027. So you haven't missed anything. You have the rest of the year in order to do some tax planning, and that really is the topic here. If you do proper tax planning, you can often reduce the amount of federal income taxes that you're going to owe, and in some states you may reduce the amount of state income taxes that you owe as well, just by doing some things that are not difficult to do, paying attention, and learning what we have to talk to you about, these 18 tax-saving methods. They won't all apply to everyone listening here, but they will apply to many of you. If you're retired, you need to pay particular attention because this is where some of our tax methods are going to help you more specifically with trying to reduce and eliminate that old 401k program that you probably roll over to an IRA. And the idea, of course, is to remove just enough, not too much, from your tax advantage plan to a plan such as a Roth IRA so that you can earn income without paying taxes on that in the future. And the important thing is not to get a big, heavy tax burden by just removing, tens of thousands of dollars that one year, particularly if this money is for the future and there's no reason for you to take it out of that 401k except to try to balance out on the taxes. So we'll get into that more here. We also have quite a few articles on retirecoast.com that deal with this, many tax strategies. We go deeper into this, into specific tax strategies for different types of advantage plans. And for those of you that are not retired yet, that HSA plan is outstanding. It may be, in fact, the very best of all of those tax advantage plans. So take a look at that. Listen to it on this podcast, but take a look at it in some depth on retirecoast.com, where we have a lot of planning tools. Also, consider our membership. We have two. We have an estate planning membership, which is important for planning for the future. All of these documents and things in there will save you a tremendous amount of money with lawyers so that at the end you can take the finished product to the attorney, have them say yes or no, make a couple of corrections, and you move on. We also have a business membership as well to help you plan your small business, regardless of what it is. It might be just, you have a blog, or you're selling some things online, or you decided to cut some grass after you retired, or even today. So the business membership can help you as well, and both of those memberships are going to save you a lot of money. If you're a millennial, we have a millennial planning membership, which is very valuable to you. Take a look at those at retirecoast.com. The balance of this podcast is going to be a dialogue, which I think helps a great deal. You can listen to my voice, and I can talk about this. I know a lot about it. I wrote the actual article that we used to create the podcast. And through this dialogue, you're going to hear a lot of information, some things I probably may not think about mentioning, but all of the relevant details from the actual full-length article at retirecoast.com were used to create this podcast. So listen to it, and I'll see you at the other side. Thanks.
You are probably giving the federal government an interest-free loan right now.
Oh, absolutely.
And the absolute craziest part is that the 2026 tax code specifically gave you a way out of it, but you just haven't updated your W-4 to actually claim the money.
Yeah, it's a classic case of legislative theory just crashing right into administrative reality.
Right.
Like, the law changed, but the software running your life did not. And if you aren't paying attention, your monthly cash flow is really suffering for it.
Which is exactly why we are pulling this apart today. It is Monday, June 8, 2026.
A very important year for tax changes.
Exactly. And look, if you're listening to this on your commute or, while you're making dinner, you know that the moment someone says federal tax code, the natural human instinct is
to completely tune out.
Yeah, completely tune out. But stick with us, because our mission today for this deep dive is to uncover 18 distinct, highly actionable strategies to legally preserve your wealth.
And we're drawing straight from a really incredible detailed suite of June 2026 tax guides, infographics, and interactive tools.
Right, because the rules for 2026 have fundamentally shifted, and we are going to extract the most important nuggets of insight from this massive stack of source material.
And I should say, we are not just going to list off deductions.
Right, nobody wants that.
Exactly. Knowing a rule exists is just trivia. Understanding how these 18 strategies mechanically interact with each other and how you can orchestrate them throughout the year, that is how you actually build a financial fortress.
Okay, let's unpack this right away with the exact scenario I teased at the top.
Let's do it.
Because the source material highlights this as one of the most immediate, everyday cash flow wildcards for 2026.
It really is a wild card.
Right. So if you or anyone in your household works in hospitality, personal services, rideshare driving, basically anything tip-based, there's a new no tax on tips rule.
Which is a huge shift.
On paper, it sounds like an immediate raise, right? The federal government is introducing a deduction for qualifying tip income.
Yeah, but the source guide throws up this massive warning flag about a trap hidden right in your payroll portal.
Okay, so what's fascinating here is the sheer administrative lag between Capitol Hill and your employer's back office.
Right. The federal law has officially removed the income tax burden from those specific tip earnings.
So the money should just be in your pocket?
It should be. However, the legacy payroll systems, like the actual software algorithms that calculate your withholding every 2 weeks, well, they were architected around the old rules where tips were fully taxable.
I have to push back here because this seems like a completely solvable problem.
You'd think so, wouldn't you?
Yeah, like you're telling me the IRS changes a massive law and the multi-billion-dollar payroll companies just haven't pushed a quick update to stop taking the money out of my check.
I mean, you would think a simple software patch could fix it, but it's actually much more insidious than that.
How so?
Well, the burden of adjusting tax withholding historically falls on the employee, right? Not the software provider.
Oh, I see.
So if your employer's system defaults to the old withholding tables because your Form W-4 hasn't been explicitly modified by you to claim this new exemption,
then the system just blindly continues to siphon off federal taxes on those tips.
Exactly.
So, okay, let's say I'm a server at a busy restaurant. I make, $2,000 in tips this month.
A solid month.
Yeah. And the federal government says, keep it, it's tax-free. But the restaurant software says, we're withholding 22% just like last year.
Right.
I'm suddenly out hundreds of dollars of actual spendable cash this month.
Precisely. I mean, you are legally entitled to that cash flow right now, but because you haven't intervened, you are essentially overpaying your taxes every single pay period.
I know what you're thinking at home because I thought the exact same thing when I read this.
What's that?
Well, who cares?
Yeah.
Like if they take it out now, I just get it all back as a massive refund in April of 2027. It's basically a forced savings account.
That is the conventional wisdom, yeah.
But when you really look at the math...
Right. If we connect this to the bigger picture, a tax refund is categorically not a gift.
Yeah, not at all.
It is your own money being returned to you with 0% interest.
That's exactly.
And, in an economic environment where you could be earning a yield on that cash in a high-yield savings account, or, more importantly, using it to pay down, say, 24% interest credit card debt.
Letting the government hold your money for 12 months is just a severe misallocation of your capital.
It really is. It's an invisible tax on your liquidity.
And if that wasn't enough, the source material points out a second, arguably more painful layer to this trap.
The state-level differences.
Yes, the disconnect between federal and state governments. The federal government says tips are tax-free, but the guide explicitly notes that states like California have indicated they may continue to tax tip income.
Yeah, and we have to maintain strict impartiality on the policy itself. But from a purely mechanical standpoint, state governments are sovereign entities.
Right, they could do what they want.
They are not required to conform their tax codes to the federal code.
So you might find yourself in this incredibly bizarre dual reality situation.
Yes, where $1 of tip income is entirely invisible to the IRS, but highly visible and fully taxable to your state's franchise tax board.
which makes tracking this an absolute nightmare for the average person.
An absolute nightmare.
But, the guide doesn't just leave us hanging. It outlines a strict 5-step triage process for this.
And they are crucial steps.
Right. First, you have to review your pay stubs immediately. Don't just assume your HR department fixed it.
Never assume that.
Second, track your tip income yourself. Third, monitor the specific line items for federal withholding.
And fourth, you use the guide's interactive calculator to estimate your actual liability under the 2026 rules.
And fifth, actively adjust your W-4 to stop the bleeding.
The guide essentially begs you to become your own auditor. You just have to aggressively advocate for your own paycheck.
Absolutely. So, okay, we've established that the government is changing how they treat your labor, but let's look at how they are treating your consumption.
This is a really interesting pivot.
There is a brand new provision for 2026 regarding the American-made vehicle interest deduction.
Yes, a very unique addition.
When I read this, I actually had to go back and reread the paragraph because personal car loan interest hasn't been deductible since, the 1980s?
It has been decades. I mean, historically, unless the vehicle was strictly for business use, the interest on an auto loan was simply dead money.
It was just the unavoidable cost of financing a depreciating asset.
Exactly. But the 2026 code introduces a highly targeted incentive.
Okay, let's unpack this.
Eligible taxpayers can now deduct the interest paid on loans used to purchase qualifying American-made vehicles.
The mechanism here is what really caught my eye, honestly.
How so?
The guide says this deduction can be claimed in addition to the standard deduction.
Yeah.
For anyone who glazes over at tax terminology, why is that specific phrasing the holy grail of tax deductions?
Because it fundamentally changes the accessibility of the tax break.
Make that make sense for me.
Okay, our tax system has two main categories of deductions. Below the line, itemized deductions like charitable giving or mortgage interest.
Right.
Those only benefit you if they sum up to a number larger than the massive standard deduction.
And because the standard deduction is so high now, most people never get to use those itemized deductions.
Exactly. They're basically sitting behind a massive paywall of math. You have to spend a fortune to even unlock them.
Wow.
But an above-the-line deduction, which is what this American-made vehicle interest deduction effectively functions as, bypasses that wall entirely.
So wait, if you buy a vehicle that is manufactured in the U.S., meets the specific federal criteria, and your income is under the limits,
you get to take the full standard deduction and then lower your taxable income even further by the exact amount of interest you paid on that car loan.
That is a staggering shift in the math of buying a car.
It really is.
If you are sitting there right now debating between an imported SUV and a domestically produced one, or debating whether to empty your savings to pay cash versus taking out a loan, this changes everything.
It drastically alters the financing equation.
Because if the interest is suddenly tax deductible, the effective APR on that loan just plummeted.
Yes. However, and this is a big however, it requires immaculate documentation.
Of course it does. The IRS always wants the receipts.
The source material is adamant here. You cannot just guess the interest at the end of the year.
Right.
You must retain the original purchase agreements, the financing origination documents, and the precise annual statements proving the exact interest amortized and paid within the 2026 calendar year.
So keep the paperwork. Always keep the paperwork.
Always.
But let's pull the camera back for a second. We found these quirky, immediate cash flow tricks for your paycheck in your driveway.
The everyday stuff.
Yeah. But if we look at the actual pillars of your net worth over a lifetime, the tax code has essentially weaponized healthcare savings.
Oh, absolutely.
Let's look at the health savings account, the HSA. I used to think of the HSA as just, a glorified debit card for buying contact lenses and paying the $20 copay at the clinic.
That is the most common and, frankly, the most limiting way to view an HSA.
Right.
If you only use it as a short-term clearinghouse for this year's medical bills, you are completely missing the architectural brilliance of the account.
That's a strong phrase.
It's true.
Yeah.
For financial planners, the HSA is widely considered the single most powerful long-term wealth-building vehicle in the entire tax code.
I want to use a metaphor here because it blew my mind when I finally understood it.
Go for it.
The HSA isn't a debit card. It's a financial time machine.
I like that.
You put the money in using today's tax break.
Right.
It travels through time, growing completely tax-free, and it emerges decades later in your retirement to pay for future medical bills with absolutely zero tax penalty.
The guide calls this the triple tax advantage.
The time machine analogy is just so accurate because of how the underlying mechanics operate.
Right. And the triple tax advantage is unique to the HSA. No other account offers this.
Walk us through the steps.
Step 1. Your contributions go in pre-tax. So if you put in $4,000, your taxable income drops by $4,000 today.
Awesome.
Step 2, you don't just leave that money in cash. You can invest the HSA funds in the broader market index funds, equities, bonds, just like an IRA.
And as that money compounds over 20 or 30 years, all of that growth is entirely tax-free.
Which is huge because normally if you have massive gains in a brokerage account, you are paying taxes every time it grows and you sell.
Correct.
And then step 3, the exit strategy. When you finally withdraw those funds, whether it's next week or 30 years from now, as long as they are used for qualified medical expenses, the withdrawal is 100% tax-free.
It's the holy grail. I mean, even a Roth IRA makes you pay taxes on the seed money before it goes in.
Exactly.
But the HSA shelters the seed, shelters the growth, and shelters the harvest.
This is why wealth managers often advise maximizing the HSA even before maximizing a 401k, assuming the employer match is already met, of course.
Yeah. And the limits are pretty good, right?
Very generous. For 2026, the limits are $4,400 for a single individual and $8,750 for family coverage.
And if you're a bit older.
If you are 55 or older, there is a $1,000 catch-up provision.
Okay, but let me ask you a practical question.
Sure.
If I invest my HSA in the S&P 500 so it can grow for retirement, how do I pay for my actual medical bills today? I mean, I still have co-pays and prescriptions.
Well, this raises an important question about cash flow management.
Right.
The ultimate strategy, if you can afford it, is to pay for today's out-of-pocket medical expenses using your regular checking account.
So you just pay out of pocket.
Yes.
Yeah.
You leave the HSA entirely alone. You let the principal compound.
But what about those bills?
You keep the receipts for those medical expenses in a digital file. Because under current law, there is no time limit on reimbursing yourself.
Wait, really?
Really. 10 years from now, you can pull money out of the HSA tax-free to reimburse yourself for a surgery you paid for in cash today.
There's no expiration date on the receipt.
None. Which allows the invested capital inside the HSA to experience uninterrupted compound growth for decades.
That is absolutely wild.
Yeah.
But we need to make a really sharp distinction here for the listeners because the guide also mentions the FSA, the flexible spending account.
Yes, very different.
The names sound almost identical, but they operate in completely different universes.
They really do.
The 2026 limit for an FSA is $3,400. Why wouldn't I use an FSA as a time machine?
Because an FSA is inherently ephemeral. It is designed by the IRS as a use-it-or-lose-it vehicle.
Okay.
The funds do not belong to you in perpetuity. If you do not spend the money on qualified expenses within the calendar year or within a very short grace period, the remaining balance is generally forfeited back to the employer.
So you just lose it.
Yep. For 2026, the maximum carryover allowed into the next year is only $680.
Wow. So an FSA is a checking account that self-destructs on New Year's Eve.
Exactly.
While an HSA is a permanent tax-free vault for your net worth.
An excellent summation.
Okay, so we've hacked our healthcare. Let's talk about the kids, and specifically, the absolute evolution of education funding.
This is a major update.
I always viewed 529 education savings plans as this rigid, anxiety-inducing trap.
A lot of people did.
You know, you lock money away when your kid is a toddler, and if they turn 18 and decide they don't want to go to a 4-year university, the money's just stuck there. Or you pay a massive penalty to get it out.
That anxiety is exactly what historically suppressed participation in 529 plans.
Right.
But the 2026 source material details a profound behavioral shift. The 529 is no longer just a college fund.
It's way more.
The legislation has essentially transformed it into a lifetime career insurance policy.
Yeah, the list of eligible uses in the guide is sprawling. It's not just dorm rooms and university tuition anymore.
No, it explicitly covers trade schools, vocational training, registered apprenticeships, industry certification programs, and workforce training.
This is the tax code acknowledging the reality of the modern economy, isn't it?
Precisely. A traditional 4-year degree is no longer the only pathway to high earning potential.
Right.
So if your beneficiary decides to bypass the university system to attend an intensive, specialized technical school to become a master electrician, or enrolls in a highly accredited cybersecurity coding boot camp,
those 529 funds can be deployed completely tax-free to cover those costs.
completely tax-free.
Here's where it gets really interesting, though. What if they just get a full-ride scholarship?
A great problem to have.
Or what if they bypass formal education entirely, start a business at 18, and never touch the 529? That was always the nightmare scenario. You oversaved.
And that is where the most structurally significant update to the 529 rules comes into play. It acts as an ultimate safety valve.
Tell me about this valve.
If the original beneficiary does not utilize the funds, you, as the account owner, have always had the ability to change the beneficiary to a sibling or a relative.
Right, that was the old rule.
But now, under specific conditions outlined in the source, you can execute a direct rollover of unused 529 funds into a Roth IRA for that same beneficiary.
I had to read that 3 times when I saw it.
It's a game changer.
You're telling me that if my kid doesn't go to college, I can take the money I saved for their tuition and magically transform it into their retirement account?
That is the practical outcome, yes.
Wow.
Now, there are strict lifetime limits and aging requirements on the account. The 529 must have been open for a certain number of years, and the rollovers are subject to annual IRA contribution limits.
But the mechanism is still revolutionary.
It completely de-risks the act of saving for a child's education.
You are either funding their career development or you are jump-starting a massive tax-free compound growth engine for their retirement.
It completely reframes the account.
It's not just an education tool, it's intergenerational wealth transfer disguised as a college fund.
Exactly.
But what if the education isn't for the kids? What if you're listening to this, you're 55 years old, and you want to pivot your career?
There's something for that, too.
The guide outlines education tax credits, specifically the lifetime learning credit.
This is a highly underutilized provision. The Lifetime Learning Credit allows eligible taxpayers to claim up to $2,000 per tax return for tuition, required fees, and course materials.
And the key distinguishing factor here, unlike the American Opportunity Tax Credit, which is strictly capped at the first 4 years of undergraduate education.
Right, the Lifetime Learning Credit is available for an unlimited number of tax years.
So if I'm a retiree and I decide I want to take high-level courses at a local university to learn artificial intelligence, or I want to take accounting classes because I'm launching a post-retirement consulting business, I can use this.
Yes, you can. The tax code is actively subsidizing continuous adult education and skill acquisition.
That's amazing.
It directly reduces your federal tax liability while you increase your human capital. And it's important to note the phrasing. It is a credit, not a deduction.
Which is the ultimate magic word in taxes.
It really is.
A deduction just lowers the income you're taxed on, so you save a percentage. A credit is a dollar-for-dollar assassination of your final tax bill.
Perfect way to describe it.
If you owe $5,000 in taxes and you have a $2,000 credit, you now owe $3,000. Full stop.
Exactly, which is why maximizing credits like the child tax credit for qualifying dependents under 17, as well as dependent care and adoption credits mentioned in the source, is mathematically superior to chasing basic deductions.
Right.
For a growing family, stacking these dollar-for-dollar credits is the most impactful annual tax event they will experience.
Okay, so we're stacking credits for the kids, we're building 529 time machines, and using HSA vaults. It feels like we are completely optimizing our personal lives.
We're doing pretty well.
But if the government is giving us all these breaks, surely they are taking something away.
Naturally.
And that brings us to the great illusion of the modern tax code, the standard deduction dilemma.
This trips a lot of people up.
For my entire adult life, the conventional wisdom was that the key to beating the IRS was itemizing everything. You keep a shoebox full of receipts. You track every charitable donation, every state tax payment, every mortgage interest statement.
That was the reality for decades. The hallmark of a sophisticated taxpayer was itemizing deductions to chip away at their taxable income.
But the landscape has experienced a seismic shift.
Yes, it has.
The standard deduction, the flat, guaranteed amount the IRS lets you deduct with absolutely no proof required, has been raised to such astronomical heights that the old shoebox of receipts is functionally obsolete for the vast majority of Americans.
Let's look at the 2026 numbers from the guide.
Give them to me.
A single filer gets an automatic $16,100 deduction. Married filing jointly is $32,200. Head of household is $24,150.
But the kicker is the senior bonus, right?
Exactly.
If you are 65 or older, there's an additional standard deduction.
Yes, up to an additional $6,000 for a single senior or $12,000 for a married couple.
Let me do the math on that real quick. A married couple over 65 has a guaranteed, no questions asked standard deduction of over $44,000.
Right.
To even begin to benefit from itemizing, they would have to rack up more than $44,000 in mortgage interest, state taxes, and charity in a single calendar year.
which is an incredibly high hurdle, especially for retirees who have likely paid off their primary mortgage and may live in a state with low income taxes.
And this high hurdle creates a severe unintended consequence for charitable giving, doesn't it?
It absolutely does.
This is the part of the source material that legitimately shocked me. I have to play devil's advocate here.
Okay, go ahead.
Are you telling me that if I am charitably inclined and I write a check for $5,000 to my local food bank, the IRS gives me absolutely zero credit for it?
From a purely mathematical standpoint on your federal tax return, yes.
Wow.
If we connect this to the bigger picture, the government still conceptually encourages philanthropy. But the mechanics of the return dictate the outcome.
Make the math work for me.
Okay, if your total itemized deductions, including that $5,000 donation, only add up to $20,000, and your standard deduction is $32,200, your $5,000 donation is completely swallowed up by the standard deduction you were already guaranteed to take.
So it provides zero marginal tax benefit.
Zero.
It's like having a coupon for $20 off, but the store is already having a $30 off sale, and you can't stack them. You just throw the coupon away.
That's a perfect analogy.
The guide explicitly warns that charitable giving should largely be viewed as a personal or community support decision now, not a tax reduction strategy.
Primarily, yes.
But, of course, the guide doesn't just present a problem without a massive, complex loophole.
Naturally.
Enter the strategy of bunching. Let's break this down, because it's brilliant.
Bunching is essentially an exercise in strategic timing.
Okay.
It is a recognition that while you cannot beat the standard deduction every year, you might be able to beat it once every 3 or 4 years.
Walk us through an example.
Let's imagine a household that consistently donates $10,000 a year to various charities. Over 3 years, they donate $30,000.
Right.
But if their standard deduction is always $32,000, that $10,000 annual gift never pushes them over the threshold. They lose the tax benefit in year 1, year 2, and year 3.
Right. They just take the standard flat amount and move on.
But what if they alter the timeline?
Okay, how?
In year 1 and year 2, they give absolutely nothing. They take the standard deduction. Then, in year 3, they bunch 3 years' worth of intended generosity into a single massive tax year.
Oh, I see.
They donate the entire $30,000 at once. When combined with their other baseline itemized deductions, say $10,000 in state taxes, their total itemized deductions for year 3 spike to $40,000.
And $40,000 is higher than their $32,000 standard deduction.
Exactly.
So in year 3, they actually get to itemize. They capture an $8,000 marginal tax deduction that they would have completely, totally lost if they had just drip-fed the money over 3 years like normal.
Exactly. You are artificially engineering a massive spike in your deductible expenses to breach the standard deduction threshold in a highly controlled manner.
But practically speaking, that sounds terrible for the charities.
It can be.
The food bank doesn't want me to starve them for 2 years and then hand them a giant check. They need operating capital every month.
How do you reconcile the tax strategy with the actual needs of the organizations you care about?
That is the exact friction point, and it is solved by an instrument called a donor-advised fund, or a DAI.
What is that?
Think of a DAI as your own personal, centralized, miniature charitable foundation. It acts as an intermediary.
So in year 3, when I want that massive tax spike, I don't write the check to the food bank. I write the $30,000 check to my donor-advised fund.
Correct. The moment the money enters the DAI, it is legally considered a completed charitable gift by the IRS.
So I get the deduction right then?
Yes.
Yeah.
You get the massive $30,000 tax deduction on your return for that specific year. However, the DAI holds the capital.
And then what? You then advise the fund administrators on how to disperse the money. You can instruct them to send $10,000 to the food bank this year, $10,000 next year, and $10,000 the year after.
That is unbelievable. You decouple the tax event from the distribution event.
That's exactly what you're doing.
You get the massive deduction on your own carefully planned schedule, but the charity gets their smooth, predictable cash flow on their schedule.
It is the pinnacle of proactive tax planning. You are no longer just reacting to the calendar. You are manipulating it to serve your financial architecture.
So if the government has effectively killed our ability to casually deduct our way to wealth by raising the standard deduction to the stratosphere, the only lever we have left to pull is our assets.
We have to invest our way there.
This brings us to the management of taxable investments. The source guide places massive emphasis on long-term capital gains.
It is a foundational arbitrage opportunity within the tax code.
Explain that.
The system heavily penalizes short-term speculation and heavily rewards long-term conviction. If you purchase an asset, a stock, a bond, real estate, and it appreciates in value, and you sell it after holding it for 1 year or less, that profit is classified as a short-term capital gain.
And the IRS hates that.
They tax it aggressively. It is treated as ordinary income, stacked right on top of your regular salary.
So you get hit hard.
Meaning it could be taxed at the highest marginal brackets, up to 37% or more, depending on your income level.
Ouch.
But the moment you hold that exact same asset for 1 year and 1 day,
The entire tax paradigm shifts.
it becomes a long-term capital gain.
And the guide breaks down these brackets for 2026. Depending on your overall taxable income, the tax rate on that profit drops to either 15%, a maximum of 20%, or incredibly 0%.
Yes, if your total taxable income falls below a certain threshold, the federal government will literally allow you to realize infinite investment profits completely tax-free.
That's wild.
Even at the highest income tiers, paying a 20% capital gains rate instead of a 37% ordinary income rate is a massive retention of wealth. It is entirely a function of patience.
It's like aging a fine wine. The longer you keep it in the cellar, the better the tax treatment when you finally pour it.
Exactly.
But let's look at the dark side of investing. What if the wine turns to vinegar?
It happens.
What if you buy a tech stock and the company completely implodes? You're sitting on massive losses. The guide introduces a strategy here called tax loss harvesting. And I have to admit, when I first read how this works, it felt like an illegal magic trick.
It feels counterintuitive to celebrate a financial loss, but tax loss harvesting is about utilizing the tax code's acknowledgement of your net economic reality.
So how does it work?
The strategy involves intentionally and strategically selling investments that have declined in value, locking in those losses on paper.
Okay, let's play this out. I have $20,000 in profits from selling an index fund that did really well. Normally, I owe taxes on that $20,000 gain.
Right.
But I also have this single tech stock that just plummeted, and I'm down $20,000 on it. If I sell the loser, do they just cancel each other out?
Exactly. You use the realized loss to directly offset the realized gain. Your net taxable capital gain for the year becomes zero.
Right.
You essentially utilized your bad investment to wipe away the tax liability of your good investment.
So what does this all mean? What if my year was an absolute disaster and I have way more losses than gains?
Okay.
Say I have $50,000 in losses and absolutely zero gains to offset. Does the IRS just pat me on the back and say, better luck next time?
No, the rules are surprisingly accommodating here.
Really?
If your capital losses exceed your capital gains, you are allowed to take up to $3,000 of those excess losses and apply them against your ordinary income.
Wait.
It essentially acts as a deduction against your W-2 salary.
So my terrible stock pick lowers the taxes on my day job salary.
Up to that $3,000 limit, yes.
And what happens to the remaining $47,000 in losses from your example? You don't lose them.
The tax code allows you to carry those excess losses forward into future tax years indefinitely. You build a reservoir of losses that you can deploy against future gains in 2027, 2028, and beyond.
Wow. Okay, I'm logging into my brokerage account right now and selling everything in the red.
Hold on.
What?
The source guide has a massive bolded warning section right here. The wash sale rule. This is the catch. The IRS isn't stupid.
Okay, tell me about the catch.
The IRS is acutely aware of the mechanics, and the wash sale rule is their defense mechanism. It prevents you from artificially manufacturing a tax loss without actually changing your economic position.
Oh, I see.
You cannot sell a stock for a loss, claim the tax deduction, and then immediately turn around the next morning and buy that exact same stock back just because you think it's going to rebound.
Because if you could, everyone would just sell their losers at 3:59 p.m. to get the tax break and buy them back at 9:30 a.m. the next day.
Precisely. If you purchase a substantially identical security within 30 days before or 30 days after the sale, the IRS completely disallows the capital loss.
It's just gone.
It is effectively quarantined.
So you have to endure 30 days of actual market risk. You sell tech company A to harvest the loss. You are forbidden from touching tech company A for a month.
Correct.
If it rockets up 50% during that month, you miss it. That is a massive psychological hurdle.
It is the primary reason investors fail to execute the strategy. To utilize tax loss harvesting, you must admit defeat on a specific position and lock in the loss, accepting that you cannot immediately re-enter.
Is there any way around it?
A common workaround is to sell the specific stock and immediately buy a broad sector ETF, so you remain exposed to the technology sector's general movements without violating the substantially identical rule.
That is a brilliant pivot.
It works very well.
Let's touch quickly on another optimization strategy before we hit the masterclass of this deep dive. Optimizing your filing status.
This is a subtle one.
The guide states that for the vast majority of married couples, married filing jointly is the default optimal choice. You get the massive standard deduction, you get the widest tax brackets.
Yeah.
So why does the married filing separately status even exist? Why would anyone willingly choose to file separately?
You are correct that jointly is the default assumption, but default assumptions in tax planning can be extremely costly.
Okay.
Filing separately is a tactical maneuver deployed for highly specific, high-friction scenarios. Let's look at medical expenses.
I talked about those earlier.
We established earlier that itemizing is difficult. Medical expenses are even harder because they are only deductible to the extent they exceed a significant percentage of your adjusted gross income, or AGI.
So if a couple makes $200,000 combined, they have to have a massive amount of medical bills before the IRS even lets them start deducting a single penny.
Exactly. The threshold is tied to their combined income. But suppose only one spouse incurred those massive medical bills.
Oh, I see where this is going.
By electing to file as married filing separately, you isolate that spouse's income. Perhaps their individual income is only $60,000.
Suddenly, the threshold for deducting those medical expenses plummets.
They can clear the hurdle easily and capture a massive deduction that would have been mathematically impossible if they combined their incomes.
It's a surgical strike.
Yeah.
You separate the incomes just long enough to capture the deduction, and then you deal with the separate returns.
Precisely.
The guide also mentions income-driven repayment plans for student loans as a huge reason to file separately.
Yes, many federal student loan repayment plans calculate the monthly payment based on your tax return's AGI.
Right.
If you file jointly, the government bases your payment on your combined household wealth, which can cause the required monthly payment to skyrocket.
But if you separate them,
By filing separately, the borrower can often legally isolate their income, forcing the government to calculate the payment based solely on their individual lower salary.
that could save a fortune.
It requires a meticulous side-by-side comparison by a CPA, but it is a vital tool.
Which perfectly sets up the absolute centerpiece of this deep dive, the masterclass.
Here we go.
We are moving from general investments and immediate cash flow into the single biggest, most complex long-term strategy detailed in the 2026 source material.
It's the big one.
How do you protect your wealth when the paychecks permanently stop?
Retirement.
We start with the foundation, maximizing retirement contributions. The limits for 2026 are significant. $7,500 for an IRA and a massive $24,500 for employer plans like a 401k, plus catch-up contributions for older workers.
That is the accumulation phase. Every dollar you push into a traditional 401k or IRA is a dollar that avoids taxation today.
It lowers your current taxable income.
Exactly. But saving the money is only half the battle. The far more complex and dangerous phase is distribution. The IRS gave you a tax break today because they expect to tax that money and all of its growth when you pull it out in retirement.
And that brings us to the most expanded section of the guide, strategic Roth IRA conversions.
This is crucial.
Let's strip away the jargon. A Roth conversion is simply taking money from a traditional IRA where it hasn't been taxed yet and moving it into a Roth IRA.
Right.
But to unlock the door between those two accounts, you have to pay the toll. You have to pay the taxes on that money right now.
You do.
I have to be honest, I struggled with this when I first read it. Why on earth would I volunteer to stroke a massive check to the IRS today if I could just leave the money in the traditional IRA and not pay taxes for another 10 years?
I completely understand why you'd think that. It feels like financial self-sabotage to volunteer for taxation.
It really does.
But a Roth conversion is the ultimate exercise in arbitrage and delayed gratification.
Okay, sell me on it.
The objective is not to avoid taxes entirely. That is a fantasy. The objective is to proactively choose when to pay them.
Timing.
You want to pay the taxes when your marginal tax rate is at its absolute lowest to avoid being forced to pay them later when your rates might be substantially higher.
Because once the money crosses the threshold into the Roth IRA,
The compounding growth and every single qualified withdrawal you take for the rest of your life is 100% tax-free.
okay, so it's a calculated bet on my tax brackets. But how do I know when my rates are at their lowest? I'm working, I'm making a salary, my rates are high.
This is where financial planners look for the anomaly.
The anomaly.
They look for what the source guide calls the retirement tax window.
Tell me about this window.
Imagine a timeline of your life. You work for 40 years, generating a high salary, keeping you in a high tax bracket. Then, one day, you retire.
The W-2 salary instantly drops to zero.
But perhaps you have enough cash savings to delay claiming Social Security until age 70 to maximize the monthly payout.
Right.
And crucially, the government does not force you to start withdrawing from your traditional IRA until age 73.
Oh, I see it. You have this massive gap, this window of maybe 5 or 7 years in your early 60s where you aren't working, you aren't taking Social Security, and you aren't forced to pull from your IRA.
Exactly.
Your actual on-paper taxable income might temporarily plummet to almost zero.
You become temporarily one of the lowest income taxpayers in the country, despite having millions in the bank.
That's crazy.
This retirement tax window is the golden era for Roth conversions. During these specific years, you voluntarily move large chunks of money from your traditional IRA to your Roth IRA.
Because your other income is so low, you pay taxes on those conversions at rock bottom 10% or 12% rates.
The guide uses an incredible analogy here called bracket management.
Yes, I want to visualize this for the listener.
Imagine the progressive tax brackets as a series of stacked buckets.
Okay, buckets.
The lowest bucket is the 10% bucket.
Yeah.
Once that fills up with income, the overflow spills into the 12% bucket, then the 22% bucket, the 24% bucket, and so on.
Right.
Bracket management is the surgical process of looking at your tax return in December, calculating exactly how much empty space is left in a low tax bucket, say the 12% bucket, and converting exactly that precise dollar amount from your traditional IRA.
Wow.
You fill the 12% bucket to the absolute brim, but you stop before a single drop of conversion money spills over into the 22% bucket.
That is brilliant. You just siphon the traditional IRA dry, year by year, bucket by bucket, locking in a 12% tax rate today so that when you're 80 years old, you aren't forced to pull that money out at a 30% or 40% tax rate.
Precisely. It is multi-year strategic maneuvering.
I was looking at this conversion math in the guide, and it looked perfect, a flawless strategy, until I hit this massive hidden landmine called the IRMA trap.
Oh, IRMA is dangerous.
I had to read this section 3 times. Are you telling me that doing a Roth conversion today will trigger a hidden penalty on my health care multiple years from now?
It is one of the most dangerous invisible traps in retirement planning. IRMA stands for Income-Related Monthly Adjustment Amount.
What does that actually mean?
It is essentially a surtax, a wealth penalty, layered onto your Medicare premiums.
Most people assume Medicare Part B and Part D cost the same for everyone.
They do not. They are dynamically tied to your taxable income. If your income crosses certain arbitrary thresholds, your monthly Medicare premiums can violently spike.
So if I am executing this brilliant bracket management strategy and I convert $100,000 from my traditional IRA to my Roth IRA to fill up my tax buckets, that $100,000 counts as gross taxable income for this year.
It absolutely does, and it pushes your adjusted gross income straight through the IRMAA thresholds.
But here is the truly insidious part. The look-back rule.
Yes, Medicare does not base your current premiums on your current income. They operate on a 2-year delay.
So what does this all mean? Let's put years on it.
If you execute a massive Roth conversion today, in 2026, you pay the income tax in 2026, you think you are done.
But you're not.
No. 2 years from now, in 2028, the Social Security Administration looks back at your 2026 tax return, sees that massive spike in income from the conversion, and hits you with an IRMAA surcharge that could cost you thousands of extra dollars in Medicare premiums for the entirety of 2028.
It is brutal. It completely wrecks the math of the conversion.
It certainly can.
You think you saved 10% on income taxes. Yeah. But you lost it all to Medicare surcharges. It really proves the point that you cannot make these decisions in a vacuum.
You have to thread the needle between the tax brackets and the IRMA cliffs simultaneously.
But before we move off Roths entirely, I want to pivot to the estate planning side.
Okay.
The guide dedicates a section to leaving assets to heirs. If I'm dead, why do I care if I leave my kids a traditional IRA versus a Roth IRA? Money is money.
Because the Secure Act fundamentally altered the landscape of inheritance.
How so?
Historically, if you left a traditional IRA to a child, they could stretch the required withdrawals over their entire lifetime, minimizing the tax impact.
But that rule changed.
That rule has been eradicated for most non-spouse beneficiaries. Today, if your child inherits your traditional IRA, they are generally forced by law to completely empty that account within 10 years.
Where they have to drain the whole thing in a decade.
Yes. And every single dollar they are forced to withdraw is added to their taxable income. If your child is in their 40s or 50s, navigating their own peak earning years, And suddenly they're forced to take massive, mandatory taxable distributions from an inherited IRA.
That inheritance could easily be taxed at the absolute highest marginal federal and state brackets.
You are leaving them a ticking tax time bomb.
But if I do the Roth conversions during my retirement tax window, and I leave them a Roth IRA instead,
The 10-year liquidation rule still generally applies. They still must empty the account within a decade.
Wow.
However, because it is a Roth IRA, every single distribution they take is completely 100% tax-free.
Wow.
They inherit the wealth, but the tax liability has been entirely neutralized. It is an incredibly powerful legacy.
Which brings us to the ultimate question and transitions us into Section 6 of our breakdown.
We're making good time.
We've talked about all these complex maneuvers to get money out of the traditional IRA. Why go through all this trouble? Why not just leave the money in the traditional IRA forever, never convert it, and just let it ride?
The RMD.
The answer, according to the source, is the looming mandatory tax threat called the RMD, required minimum distributions. This is the government finally knocking on the door to collect.
The tax-deferred retirement system was never designed to be a permanent tax shelter.
Right.
Congress allowed you to deduct contributions for decades to incentivize saving, but eventually they demand their tax revenue.
And the RMD rules are the enforcement mechanism.
Once you reach a certain statutory age, you are legally mandated to begin withdrawing a highly specific percentage of your traditional retirement accounts every single calendar year, regardless of whether you actually need the cash flow to survive.
And those forced withdrawals are taxed as ordinary income, right at the top of your tax bracket.
Exactly.
The 2026 rules peg the starting age at 73, or age 75 if you were born in 1960 or later. But what absolutely blew me away was the penalty for missing it.
It is severe.
I read this and thought it was a typo. The IRS will confiscate a quarter of the money just because you forgot to make a withdrawal.
It is arguably the most draconian penalty in the entire federal tax code.
That's insane.
Historically, the penalty for failing to take an RMD was an astonishing 50% of the amount you were supposed to withdraw, but failed to.
50%.
Recent legislation has reduced that default penalty to 25%, and it can potentially be further reduced to 10% if you correct the error within a timely manner.
Still, a 25% instantaneous wealth tax for an administrative oversight is staggering.
It really is.
Let's walk through the actual mechanics of this. How does the IRS figure out how much I'm forced to withdraw? Is it a flat dollar amount?
No, it is a dynamic calculation driven by your life expectancy.
Yeah.
The IRS publishes a specific demographic table. Every single year, you must take the total balance of your retirement accounts on December 31st of the prior year and divide that balance by the IRS life expectancy factor that corresponds to your exact age.
Okay, let's do the math on the example provided in the guide. Let's say I'm forced into R&D age, and I have exactly $500,000 sitting in my traditional IRA.
Okay, $500,000.
I look at the IRS table, and my factor is 26.5.
You take the $500,000 balance and divide it by 26.5. That equals approximately $18,868.
Okay.
That specific dollar amount is the minimum you must withdraw before December 31st. And remember that $18,868 is stacked directly onto your existing income for the year and taxed at your highest marginal rate.
Right.
And next year, as your balance changes and your life expectancy factor shrinks, you run the calculation all over again.
But it's not just the income tax on the $18,000 that hurts.
Yeah.
The guide talks about the collateral damage, the domino effect.
The domino effect is real.
It says that extra RMD income can cause up to 85% of your Social Security benefits to suddenly become taxable.
That is the true danger of the RMD. It acts as an income multiplier for other taxes.
How does that work?
The IRS uses a complex formula called provisional income to determine how much of your Social Security is taxable. By forcing you to take an RMD, they artificially inflate your provisional income, which crosses the threshold, instantly transforming your previously tax-free Social Security benefits into taxable income. And of course, that inflated AGI triggers the IRMAA Medicare spike we discussed earlier.
It's a cascade of taxation, which is exactly why proactive planning, like draining the traditional IRA via Roth conversions before you hit age 73, is so critical.
Exactly. If the account balance is smaller, the forced division is smaller, and you avoid tripping all those wires.
But let's say I'm listening to this, I'm already 75, I have a massive forced RMD coming this year, I don't need the cash to buy groceries, and I am furious about the tax hit. Is there an emergency escape hatch?
There is a highly specific, entirely legal bypass valve known as the QCD, the Qualified Charitable Distribution.
How does that work?
If you are age 70 and a half or older, The tax code explicitly allows you to transfer funds directly from your traditional IRA to a qualified 501c3 charity.
Wait, directly? I don't withdraw the money to my checking account first.
That is the critical distinction. The funds must move directly from your IRA custodian to the charitable organization.
So it never hits my bank.
Because the money bypasses your personal bank accounts entirely, it is never recognized as gross income on your tax return. It is invisible to the IRS.
But does it count for the RMD?
Yes. The law allows that direct transfer to count dollar for dollar towards satisfying your required minimum distribution for that year.
That is brilliant. If we go back to our earlier discussion about the standard deduction dilemma, if I took the RMD to my checking account, paid the taxes on it, and then wrote a personal check to the charity, I wouldn't get a tax deduction because my standard deduction is too high. I'd be paying taxes on money I literally gave away.
Exactly. You'd lose the benefit.
But the QCD completely short-circuits that problem.
Precisely. It is an above-the-line exclusion. For charitably inclined retirees facing RMDs, the QCD is unequivocally the most tax-efficient method of philanthropy in the entire code.
It's so smart.
It fulfills your charitable intent, satisfies the federal withdrawal mandate, and suppresses your adjusted gross income to protect your Social Security and Medicare premiums.
I love that strategy. It's so clean. Now let's explore a totally different escape hatch.
Okay, what's next?
What if you want to avoid these retirement tax traps by simply refusing to actually retire?
Well, that's one way to do it.
Strategy number 10 and 14 in the guide outline post-retirement businesses and family hires. Let's say I retire from my corporate job, but I start a boutique consulting firm in my late 60s.
Transitioning from an employee to a business owner unlocks an entirely different parallel tax code.
Right.
Generating 1099 consulting income provides access to specialized retirement architecture, such as a SEP IRA or a solo 401k.
Those have much higher limits, right?
Drastically higher contribution limits than a standard individual IRA, allowing you to shield massive amounts of your new consulting revenue from current federal taxation.
And then there's the strategy of hiring family members. I have to admit, I laughed out loud reading this section.
It sounds like a joke, but it's not.
The idea of putting my grandchildren on the payroll to run my consulting firm's TikTok account to save on my taxes just sounds absurd. But the guide treats it as a serious, heavy-hitting strategy.
It is a profoundly powerful strategy, but it requires rigorous compliance.
I imagine the IRS watches this closely.
The IRS is acutely aware of the potential for abuse here. You cannot simply put a toddler on the payroll or pay a teenager $100,000 for doing absolutely nothing.
Right.
The employment must be legitimate. The family member must perform real, documented work that is necessary for the business, whether that is administrative data entry, website maintenance, or legitimate social media marketing.
Okay, so it has to be real work.
And crucially, the compensation must be reasonable and commensurate with market rates for those specific services.
Okay, so assuming I have timesheets, I have a job description, and my grandkid is genuinely editing my consulting videos, how does paying them a fair market wage actually save me money on taxes?
It relies on a concept called income shifting.
Income shifting.
When you pay the child a legitimate wage, you deduct that wage as an ordinary business expense.
Lowering my profit.
This reduces the net profit of your business, directly lowering the amount of income subjected to your high marginal tax brackets. You have successfully shifted that income away from yourself.
And where did it go? It went to the child.
Exactly. And because the child's total annual earned income is almost certainly well below the standard deduction threshold of $16,100, that shifted income is entirely absorbed by their standard deduction.
They effectively pay zero federal income tax on those earnings.
You have moved capital from a 30% or 35% tax environment into a 0% tax environment.
Here's where it gets really interesting, though. The guide takes this one step further, tying it back to our earlier strategies. Because the child now has legitimate, documented earned income, they are legally eligible to contribute to a Roth IRA.
Which is the ultimate financial masterstroke.
It really is.
You can use your business to legally shift income tax-free and then funnel that capital directly into a Roth IRA for the child, jump-starting 50 or 60 years of uninterrupted, tax-free compound growth.
You are generating a tax deduction for your business today while building an intergenerational fortune for tomorrow.
That is the definition of a financial win-win.
Right. We are rounding the final corner of our deep dive. We've talked exclusively about federal rules, But the guide explicitly reminds us that the IRS isn't the only one with their hand in your pocket.
Or forget the states.
State income taxes. I always joke with my friends about moving to Nevada or Wyoming just to escape the tax man. But is it actually worth uprooting your entire life to save a few percentage points?
For some retirees, the financial impact of geography is not just a few percentage points. It is staggering.
Really?
We have spent an hour dissecting federal optimization, but state tax systems are completely sovereign. They write their own rules.
Right.
Currently, there are several states that levy absolutely zero state income tax, including Florida, Texas, Tennessee, Nevada, Wyoming, and South Dakota.
Moving from a high-tax state like New York or California to a zero-tax state can instantly increase your net cash flow by 8% to 13% without changing a single investment.
It's an instant raise.
But the guide also points out a nuance here. You don't necessarily have to move to a state with zero income tax. It highlights states that do have income tax, but offer massive targeted exemptions specifically for retirees. It uses Mississippi as an example.
Mississippi is a prime example of a state weaponizing its tax code to attract demographics.
How so?
While they do have a state income tax system for working professionals, their code generally entirely exempts qualified retirement income.
Really?
Pensions, Social Security benefits, and distributions from IRAs and 401ks are shielded from state taxation.
That's massive.
When you are projecting the long-term drain on a retirement portfolio, the delta between withdrawing funds in a tax-heavy jurisdiction versus a tax-exempt jurisdiction can easily compound into hundreds of thousands of dollars of preserved wealth over a 20-year retirement.
But obviously, the tail shouldn't wag the dog. You shouldn't move somewhere you are miserable, away from your family and your grandchildren, just to optimize the spreadsheet. Tax planning should serve your life goals, not dictate them.
Absolutely. Quality of life must remain the primary metric.
Which perfectly tees up the final overarching strategy in the guide. Work with a proactive tax professional. The source material draws a very sharp, aggressive line between tax preparation and tax planning. For most people, those are the exact same thing.
Conflating the two is the most expensive mistake an individual can make.
What's the difference?
Tax preparation is an exercise in history. It occurs in April. You hand a professional a stack of W-2s and 1099s detailing economic events that occurred in the past. The professional simply records that history onto government forms. It is entirely reactive. You cannot change the past. Tax planning, however, is forward-looking. It is proactive architecture.
The guide literally says tax season is a myth. Wealthy people treat taxes as a 365-day-a-year event.
If you wait until April to consider your tax liability, the calendar year has already closed. You cannot retroactively execute a Roth conversion for the prior year.
You can't travel back in time.
Exactly. You cannot travel back in time to harvest a stock market loss in October or set up a donor-advised fund to bunch your charitable contributions. Navigating the sophisticated interplay of these 18 strategies requires evaluating decisions in real time.
The guide provides a really rigid calendar highlighting key action dates. It's not just April 15th. You have January 15th, April 15th, June 15th, and September 15th for managing quarterly estimated tax payments if you have consulting income or massive investments. But the most critical deadline it hammers home is December 31st.
Because December 31st represents the absolute unforgiving closure of the tax year for execution. If you miss that midnight deadline for taking your required minimum distribution, you face the 25% penalty. If you miss that deadline for executing your bracket-managed Roth conversion, that specific year's low-tax bucket is gone forever.
Wow.
A proactive professional ensures you are continuously looking through the windshield to spot these opportunities rather than staring in the rearview mirror in April wishing you had acted.
Okay, let's take a breath and recap this incredible journey through the 2026 code. We started by dodging the W-4 withholding traps on the new tax-free tips rule and realizing we need to advocate for our own paychecks. We uncovered the above-the-line deduction for financing American-made vehicles. We realized the HSA is not a debit card, but a triple tax-free time machine, and that 529 plans have evolved from rigid college funds into lifetime career insurance that can magically transform into a Roth IRA.
We examined the mathematical reality of the massive standard deduction and how engineering a bunching strategy through a donor-advised fund can resurrect lost charitable tax benefits. We walked through the severe 30-day quarantine of the wash sale rule during tax loss harvesting and how isolating a spouse's income by filing separately can unlock blocked medical deductions.
And then we hit the masterclass, identifying the retirement tax window. filling up tax buckets with surgical Roth conversions to drain the traditional IRA, completely neutralizing the looming threat of the RMD cliff and the hidden, delayed trap of IRMAA Medicare spikes. We learned how to bypass taxable income entirely by sending RMDs directly to charity via QCDs. And finally, the realization that you can hire your grandkids to shift income and potentially relocate to a tax-free state to cap it all off.
It is a comprehensive, interconnected framework for wealth preservation.
So, to you listening right now, our call to action is immediate and simple. Do not let this just be an interesting hour of audio trivia. When this finishes, take 10 minutes. Check your payroll portal and review your W-4. Look at your 529 beneficiaries, map out your age timeline, and see exactly how many years you have until your own retirement PAX window opens. Take active control of your financial architecture.
Before we sign off, I want to leave you with one final conceptual thought to mull over, one that ties this entire deep dive together.
What's that?
We have spent an hour discussing highly technical mechanisms, and it is very easy to view the federal tax code as nothing more than a burdensome, boring mathematical rulebook. But it is not.
No.
The tax code is, in reality, a psychological map of exactly what the government desires you to do. By offering you an above-the-line deduction to finance an American-made vehicle, or granting you triple tax-free growth to fund your own health care, or subsidizing your education at a trade school, the tax code is actively attempting to engineer societal behavior.
Right.
You are continuously being nudged by invisible incentives. So the question to ask yourself as you analyze your own finances is this. Look at the broader economic landscape. What behavior do you think the government will attempt to heavily incentivize next? And is your portfolio positioned to capture that advantage before the crowd?
That is a profound way to look at it. It is not just math. It is behavioral engineering on a national scale. Which brings us right back to where we started. The financial landscape is not a clean binary X-ray. It is a complex, ever-shifting board game. But hopefully after today, you feel like you finally have the real rule book in your hands and you understand how the pieces move. Thank you for joining us for this deep dive. We'll catch you next time.
Well, this podcast should give you some food for thought. We covered a lot of ground here, and anything dealing with money, I realize that it's difficult when you listen to a podcast. A lot easier when you look at it in print or on the screen. So I would strongly suggest that you go to our article at retirecoast.com. We've got the link in the show notes for this specific article, but you can always just check it out by putting taxes in the lookup function. And you'll see many other articles that I mentioned earlier on. I think it's important that you pay your taxes. Everyone needs to pay taxes. We can argue whether they do the right thing or not, but it is your legal obligation to do so. However, it is also your moral obligation not to pay any more than you should have to pay. And many people often do because they wait until the end of the year before they start thinking about what they're going to do, and then there's no time left. So you've got plenty of time now from the time that we publish this. Now, if you listen to this later in 2026 or even in 2027, not much actually changes. Congress added a few extra goodies that we mentioned in here. But for the most part, the tax tables, they are indexed for inflation. So other than that, what I'm saying here is probably going to be good all the way through 2027, although we fully expect to update this podcast. It's all about, in my opinion, planning for you to understand the different things that you can do. And other than, as I said, just the tax table indexing changing a little bit, the theories that are covered in here are going to be accurate for you regardless in the next few years until any of these laws either sunset or they change, which is unlikely at least over the next couple, 2 or 3 years. So thank you for coming, and I appreciate that. Come back to listen to other podcasts. We are covering the 250th anniversary, also with many podcasts and articles on retirecoast.com. Again, thank you. And come back to our podcast and visit our website at retirecoast.com.